Welcome, everyone. I'm Susan Murray. I'm one of the partners at Trust Associates. And on behalf of my colleagues at Trust Associates and, of course, the team at Edison, I'd like to welcome you to our first webinar of 2024, where we're going to focus on the challenges facing investment companies. So we're delighted to have three speakers joining us today to address that topic. Firstly, Joe Winkley. Now, Joe is head of investment companies and a director at Winterfloods. He advises over 50 investment companies and is responsible for all listed fund transactions, including IPOs, issuance, and corporate advisory. And Joe will focus on the a broker perspective today. Our second speaker is Kate Cornish-Bowden. Kate is an experienced non-exec director and former fund manager. She is chair of International Biotechnology Trust and a non-exec director of Finsbury Growth and Income, CC Japan Income, and European Assets. Now, Kate's going to focus on a board perspective, and in particular, the experience of taking International Biotechnology Trust to a new management house. And our third speaker today is Gemma Woodward. Gemma is head of responsible investment at Quilter Cheviot and has over 25 years' experience of managing investments. And Gemma is going to focus on an investor perspective. So before we start, just a couple of housekeeping points. Each of our speakers is going to speak for around 5 to 10 minutes. Now that's going to leave plenty of time for questions at the end. And we're going to aim for a finish time of around 11:45 a.m. If you'd like to ask a question, and we hope that you do, you can find the Q&A tab at the bottom of the screen, and we'll do just our very best to cover as many as we can within the time we have for us. Now, over to our speakers. Joe.
Good morning, everyone. I'm kicking off, and I'm going to start by doing a fairly brief kind of market update overview. What have we seen over the last year or so, and kind of what do we expect going forwards? So if we can move to the first slide. There's a lot of things to look at here, which are not particularly pleasant viewing, I suppose I would describe as. 2022 was, as a flag here, the worst calendar year of absolute performance since 2008. This is for the investment trust sector. And 2023, if we were having this webinar, I probably would have said in October 23, we'd be looking at pretty much, I would say, the nadir in terms of discounts across the entire sector. The good news is that sitting here in January, we've seen a pickup, but there was a point at which the overall sector discounts moved out to nearly 20%, which is a level we haven't seen for a very, very long time. In terms of kind of how that breaks down, we are looking at, if you look at the right-hand chart, you can see the alternative sector, which is the green chart, which is the sector including alternatives. That has obviously, we've seen, driven wider discounts in the pure equity sector, which is the black line, but nonetheless, the entire sector as a whole really has seen discounts moving to all-time lows. As I said, the good news is there has been a bit of a rebound, but I'll touch on that later. I don't think we should necessarily get too carried away. If we can go on to the next slide. This is looking at the yield curve. So on the right-hand side, you've got the inverted yield curve versus overall sector discounts. And you can see, again, a number of the alternatives in particular are bond or quasi-bond proxies, very income focused. And you can see here how, as we've seen interest rates change and yields change, so we've seen discounts change. And obviously in the current environment where inflation has been coming down and the prediction is will continue to come down, we would expect that to see a narrowing of discounts, particularly if we get rate cuts coming through. And obviously there's a lot of speculation about when in 2024 those may happen. If we move to the next slide, this is really kind of getting into a little bit of detail in terms of what I was talking about before in terms of the derating. So this is looking back over 2 years. So this is showing where the deratings have happened over the last 2 years. And as you can see, it is very much around that alternative space, particularly the income-focused alternative space. So things like infrastructure, real estate, those kind of sectors have seen really significant deratings. And at the far left here, growth capital derating of over 50% over that period. So there have been some quite brutal changes in terms of the kind of movement in terms of discounts over that period. Looking at the next page, this is looking at the fundraising, and given the kind of backdrop that I've just outlined, it's unsurprising that during 2022 we saw a material drop-off in fundraising for 2021. And as flagged here, it was the first year since 1978 where there hasn't actually been an IPO in the investment trust sector. 2023, there have been a couple of small IPOs, but you can see here in terms of the overall numbers, it has really reduced from even 2022, with only 1.2 billion raised across the sector. So that is the lowest certainly since our records began. In terms of looking at it from a quarterly basis, again, you can see here how in Q3, Q4 of 2023, there has been a really minimal level of issuance. And I think, again, I'll talk through in a minute where that might go. It does feel the only way is up, but I think we will see subdued issuance certainly for a period of time. And then looking at the next page, this is the flip side of the coin, obviously, where we are in a period of wide discounts. There has been a material pickup in buybacks, and you can see here in 2022, increase in buybacks over 21 with a really big step up in 2023. It is one of the things that certainly in terms of the broking side and speaking to boards, I'm sure there'll be a number of people on this webinar who are very aware of discounts and whose trusts are very active in buybacks. But it is interesting that there has been a response, a market-based response, to try and do something about those levels of discounts. And so we have seen a really material pickup in the level of buybacks over the last year or so. At the same time, we've also seen a real increase in corporate activity. So if we can go on to the next slide. I kind of flag in the first bullet point here that the corporate activity is generally being concentrated among subscale funds on wide discount. That's not always the case, but if you go back a few years, you would probably say that there would be a handful of kind of corporate events per year, and you can see here over the last 12 months or so, we've seen sort of 18 different M&A events. Not all of them have been executed, but the vast majority have. We've seen a large number of strategic reviews, and we've seen a number of funds announce that they're either delisting or they are liquidating. So again, to my mind, this does actually highlight that the investment trust sector is active. Boards are prepared to take action. Yes, there are kind of external pressures in terms of discounts and sometimes external pressures in terms of shareholders. But nonetheless, it is interesting to see how active the sector has been in trying to address some of the issues that have been created by the market conditions that I talked about earlier. And then if we just go through to the final slide, what I've tried to do here is kind of focus a little bit on kind of where the challenges are and kind of how things might play out from here on in. I think there are signs that the worst is over. We have seen the discounts come from lows, and again, that has to be put into context. Looking at the current sector discount, it is still around about 15%. That is still very wide from a historic perspective. But I think what's really important here is what we are seeing behind the scenes from an investor perspective. A lot of the discount widening that we've seen was driven by, I would say, almost kind of forced sellers. So these are open-ended funds, income funds, and multi-asset funds that were seeing redemptions from their underlying investors, and therefore they had to unwind their investment trust holdings. Our feeling, and certainly what we're being told, is that redemption cycle has slowed down, in many cases stopped. We're not at the stage of seeing significant inflows into those strategies, but certainly the outflows have reduced. From a retail perspective, retail investors have been largely sitting on their hands, and again, we are seeing a slight pickup in terms of retail involvement. And on the wealth managers side, again, we are seeing tentative signs that wealth managers are now looking at this and saying, actually, there may be opportunities here to pick up very good, high quality investment trusts at very low ratings. And so it does feel that the investor sentiment is starting to improve. I flag here the cost disclosures. Again, this will be something that many of you are familiar with, but there is momentum behind changing that, and that has been an impediment certainly to a number of institutional investors in the sector. We are seeing inflation falling, interest rates cuts are predicted, so it does feel that 2024 could be a better year, certainly a better year than 22 and 23. But at the same time, the challenges are there. Activist investors, I mean, there's been a lot of press, a lot of talk about Saba. They have declared holdings in, I think, 11 investment trusts now, but they have much wider holdings across the sector. Typically, they have been buying in at anything around a sort of 15 discounts. One thing to flag here is that we have seen them selling out, though. So this is not necessarily a buy and hold. There is an element of rotation where they will buy in at wide discounts and then sell out as discount narrows. So as the sector as a whole continues to re-rate, and assuming that continues, I think we would expect to see Saba reducing its holdings rather than adding to them over time. I flag here wealth manager consolidation. Obviously, we've seen Investec and Rathbones get together, and there are a number of consolidations over the sector. There is a question mark in terms of size of some of these investors and to what extent investment trusts can remain valid. At the same time, I would say we are still seeing interest from the sort of smaller mid-tier wealth managers. So wealth managers are still going to be a very important part of the sector, but there is a question mark, I think, in terms of some of the larger wealth managers and how long they will continue to hold investment trusts. Obviously, from a macroeconomic perspective, there's a lot of uncertainty. That is going to continue through 2024, and obviously it's very difficult to predict how that might impact things. And as I said earlier, it is worth flagging that even with a little bit of a re-rating sort of coming into the end of 2023, discounts are still over 10%. They are still very wide compared to historic averages. But there are positives. I think investment trust structure, we have seen articles sort of saying, is this the end of investment trusts? I think all of that is very, very premature. I think the structure is resilient. It is very well suited for, let's say here, illiquid. I think it's very well suited to both liquid and illiquid asset classes, provided you've got the right investment mandates. The ability to pay dividends out of revenue and capital reserves. We've seen a number of investment trusts take advantage of that, and it has been successful in a number of instances. So there are real advantages in the structure. So very sort of quickly, in terms of where I see things going forward, and this is very much a personal view, I think we will see improved performance and narrowing discounts. And this is the reason why I think we're seeing investors really starting to look at this space. There could be this double whammy, as I say here, where not only do you see strong performance, but you also see discounts coming in, and you get the improved share price as a result of that. I don't think the corporate activity cycle is in any way finishing. I think we will see a lot more corporate activity during the course of 2024, and this will be driven by the same factors: shareholder concerns, discounts, and performance. Fundraising, I don't think the IPO market is going to be coming back in any size anytime soon. But again, I think as we go through 2024, we are at such a low in terms of fundraising. I can't see it getting any worse from here. So I think we will see an increase, but it'll be driven by secondary issuance primarily, potentially with maybe some IPOs coming through later in the year. But I think, first of all, we need the secondary market to resume before we can start thinking about launching new ones. So that is a very kind of whistle-stop overview, but I hope it's provided a little bit of backdrop for the conversations to follow. Over to you,
Many
Susan.
thanks, Joe. Thanks. Now, over to Kate, please.
Good morning, everyone. I noticed that on Joe's list, International Biotechnology Trust did not appear, which is slightly worrying, but I guess it's an unusual corporate action. If I could move on to just the next slide, which details the usual risk and risk warnings and disclaimers. And then if we can move on to page 3. You will see that as case studies of challenges facing investment trusts go, IBT is unusual in that performance is and was solid this slide shows that the Trust NAV has beaten its benchmark, the Nasdaq Biotechnology Index, over 1, 5, and 10 years. IBT is primarily invested in listed global biotechnology companies with a small proportion, between 5 and 15%, invested in innovative biotech companies in the private equity space. For the past 18 years, IBT's appointed manager was SV Life Sciences. IBT was the only listed investment vehicle within a successful venture capital business. The economic model and cultures of these two businesses are very different, and the regulatory obligations of a listed investment trust made running the company within a private equity partnership increasingly anomalous. So when SV suddenly served us notice at the beginning of last year, we were taken by surprise. But we understood why they would want to focus their resources entirely on their venture capital business. Next slide, please. Moving on, we have a strong, diverse, experienced, and motivated board, all of whom were able to step up when the need arose. I found having complementary skills across the board incredibly helpful, and I can't emphasize enough how important it is to ensure that board members have capacity in the event of a corporate action requiring far greater commitment than is normal for a non-executive role. Moving on, please. Next slide. Having announced the change in circumstances, the priority for the board was to speak to our shareholders and to listen to their views on what they believed the future for the company should be. With the help of Numis, our brokers, we arranged to speak to most of our major shareholders and asked them what they believed were the strengths of the company and what was important to them. The main message, which came through loud and clear, was that our shareholders were content with the existing mandate and track record and were reluctant to see a change. We used this feedback to inform our thinking during the independent review process. We received more than 20 expressions of interest from different parties looking to take on the IBT business. Together with our professional advisors, we decided on key criteria for assessment and selected a long list from which to request RFPs. We then reviewed these proposals in more detail and narrowed them down to a shortlist of 6 whom we invited to present to the board. In addition to assessing the commercial details of each proposal, these presentations allowed us to question the investment philosophy, the administrative expertise, the marketing strength, the organizational culture, and the regulatory experience of the different respective bidders. The preferred partner for the business selected by the board following these presentations was Schroders. Next slide, please. This slide gets behind our thinking. As I said, the clear message was received from our shareholders that they were happy with the current mandate and were keen to see continuity. Some of our shareholders hold more than one healthcare investment trust and wanted to ensure that our particular approach remained. Most shareholders were very pleased with the track record of Elsa Craig and Marek Posipczynski, our portfolio managers, and were keen to see them stay in place if that was at all possible. The lion's share also appreciate that we pay a regular dividend out of capital. Most shareholders like our active discount management policy, and the majority also expressed a preference for maintaining some exposure to unquoted biotech investment opportunities. We have also kept the biannual continuation vote, which I'm pleased to say passed with a majority of over 99% at the recent AGM held in December. This solution gave us the continuity shareholders were keen on, plus the in-depth experience of Schroders' investment trust expertise and marketing muscle to help us grow the business. Next slide, please. This explains the reasons behind selecting Schroders. Schroders were keen to keep our existing investment mandate and to employ our portfolio management team. They have a growing global thematic funds business, and IBT gives them a key flagship biotech offering. They have an established investment trust business with 14 different investment trusts and over £10 billion under management. As a recognized brand with a significant market footprint, Schroders know their clients well, and we believe that they can help IBT grow. We were able to negotiate a commercial package to ensure that fees and ongoing costs remain competitive, and importantly, that shareholders would not have to incur any costs associated with the transition. And Schroders has a team of people dedicated to sustainability who will help complement IBT's initiatives to incorporate ESG analysis and engagement in the investment process. Moving on to the next slide. So here we are a year later, after many months of intensive work and burning midnight oil with our professional advisors. We have changed our investment manager and AIFM, renegotiated the investment management agreement and all the other contracts, changed our company secretary, our depository, custodian, and lender. The team have moved across and are happily integrated within Schroders' healthcare platform. We remain enthusiastic investors in SV's unquoted funds. Schroders are committed to growing this business, and we as a board are very much looking forward to getting back to business as usual. Thank you. I will now hand over to Gemma.
Thanks, Kate. Okay, Gemma, please.
Thanks, everyone. So I guess, well, the title slide. So I think, first of all, why did we think about doing this? And I think, we're coming at it from a perspective that we think investment trusts have actually a really good governance structure if we think about them in comparison, say, to open-end funds. So it wasn't coming at it from a perspective of, oh, this doesn't look great. It was like, actually, there is this really great kind of structure. Let's explore it a bit more. We've obviously been engaging with the investment trusts we own in our centrally monitored universe. And I say centrally monitored universe because as a wealth manager, we probably own a tiny bit of most trusts out there. So we have to be very specific. It's about what we're actually centrally monitoring. And it was the idea, we've been through some interesting times with some of the investment trusts we've owned. And the fact is, if you know the chair, if you know the board, it's much easier to deal with those difficult times if you're having that ongoing kind of dialogue. And I'd also say that, I think as shareholders, we've all got to do a bit more work as well. And I think what's interesting is certainly in the last week, I think we've seen 2 new reports come out from the wealth management sector about their kind of thoughts on things, which is, we welcome, because I think it's really important that, shareholders are engaging. I also appreciate that it can be very difficult because you put 5 shareholders in a room together, you've probably got 7 different opinions. So that's not always easy for boards to navigate. So kind of the 3 areas we looked at was board composition. And yes, that does include diversity. I was thrilled, that the FT decided to use the clickbait of diversity as, as the base of the article that it wrote about this report that we put out. And despite me saying, please don't, because it's so much more than that. But diversity is one thing, but actually the right skill sets is, just because you worked in financial services doesn't mean you're a world expert on private equity. I am not. But equally, you need to be able to understand investment trusts. So it's looking at that diversity in terms of what different people are bringing to the table. Effectiveness, and this is always a slightly elusive one in terms of what is an effective board. From a shareholder perspective, I think it's about a board that is willing to listen and engage, which may sound incredibly obvious, but I can say that not all boards are as willing to engage or listen to shareholders as others. And then finally, responsible investment disclosures. And, this is a very interesting topic, particularly where you've got US managers, because obviously ESG is woke and it is basically it will create the downfall of capitalism. And so from that perspective, what we've really been looking at is, what are you doing? We're looking at this from the perspective of, thinking about environmental, social and governance factors is about risk mitigation. We're not pretending these investment trusts are all saving the world and they're this, that and the other. What we're talking about is, how are you using those other factors to actually understand risks, and how are you actually then disclosing those? So we then RAG rated the 3 factors, and we won't tell anyone your rating. We'll give you all feedback, but we're not telling you the rating. And I think what's been really interesting is, certainly, we've had a lot of engagement from the trusts we invest in, but also a lot of other trusts, which is really pleasing, because, the sector generally seems to be really interested. And that's been really, I guess, validating for the amount of work that went into this. What we've also done is kind of set expectations for the future. This is very much a long-term engagement. We started it originally back in May 22. We published the equity part this summer. The alternatives bit, ex-property, will be coming out in the next couple of months. But it's an ongoing basis, because we're not expecting people to kind of be able to implement change immediately. So if we go on to the next slide. Thank you. So what are we thinking about? We've said the right skill set, some quite interesting ones about succession planning. I'm sorry, it's in your gift to make sure you don't have tenure cliffs unless something as really drastic has happened. So we don't kind of regard that as a reason for people to stay on. We really believe in the 9-year term. And I know that some people feel, well, when I come chair, I want to have a good crack at it. I've never sat on an investment trust board. I have sat on charity boards, and I think you get to a certain point where you're kind of like, I've been here, done this before, and I think you need some freshness that comes into the thinking personally. Overboarding, I mean, it's all the usual things. And, thinking about the recruitment processes, and obviously there are other advisors around other than trust associates, but it is like thinking about, how are you actually, how are people coming onto the board? And we'd say, it seems to be very robust processes, but the thing we're kind of got a little bee in our bonnet about, but as Joe's pointed out, isn't a problem at the moment, is what happens at IPO. Because quite often at IPO, it tends to be the manager and, perhaps the broker who are putting people into those positions. Another one is board effectiveness. We don't believe that you need to hold X amount of shares just to be a non-exec director, because we also believe you don't want to create hurdles for different people coming into actually becoming a non-exec director. But, I think for the majority of non-execs, we're kind of like, well, you can probably afford to hold the shares, so we'd quite like to see some. One of my favorite excuses about why a chair wouldn't see us was the manager telling us, he is a non-exec director, which is, I try not, I've got some great stories and I try not to dwell on those too much, because, that's the absolute outlier, but cause, I have to say, quite a lot of hilarity for us, I have to be honest. And then responsible investment disclosure. So this is a really interesting one, because we're not saying you need an ESG or responsible investment committee. There's enough committees, But what's really interesting is that at times we would question whether the board has sufficient knowledge to actually challenge what the manager is telling them. So one example is a manager saying, we don't need to sign up to the principles for responsible investment. We're better than them. There's no way you can be better than them. That's not how I won't bore you to death on the framework, but that's not how it works. And then you're like, well, actually, that's because the board doesn't understand enough. So it's about that particular challenge. Got a really good example here of one particular board. We engaged with the chair and the SID. That then kind of led us to attending the board meeting without the manager representatives. But also then engaging with manager representatives in the marketing functions and sales, etc. And that really is what we're, we're not doing that for every trust, but that really is what we're talking about. It's a partnership. It's not, it's a conversation, and it's something where we want to be constructive. And I think that's a really good example of a board that really took that on. I think it helped that we were saying what they wanted to say to the manager, to be fair, I will admit that. Next slide. So this kind of shows our RAG rating. And I think all I'm going to say about this, because I'm really aware that we've got questions coming up and stuff, is that just because you're a big trust doesn't mean that we regard you as being better at this, just because you're in particular geographies. So it's been quite interesting in that some of the largest trusts we had some more significant issues with. And actually, we saw some really good kind of outcomes within the markets where you might not expect it, Asia, Japan, and EM. So it's not as obvious as large UK, it's all going to be great. It came out as quite a different kind of mixed bag, which I think why it's really useful to do this process for us is because then we can kind of do away with some assumptions which turn out to be totally wrong. So final page really is just looking at our expectations. I think, I don't think there's anything particularly controversial about this. We're also very much aware that this is a process. It's not, you can't change overnight. And also we're very much in an environment from a responsible investment perspective that is constantly developing, particularly with the new, SDR regulations that start coming in this year. But this is very much what we're expecting. It will evolve over time. What is good now isn't necessarily good in 5 years. And I think that's the other thing about kind of setting this up for kind of success in the future as well. Thank you.
Emma, thank you very much. That's great. Okay, so let's move on to some of the questions. We've got a few coming through, so please do feel free to add to the list. Let's start. Oh, I don't know. Maybe Joe on this one. Why was Picton property deal terminated? Was there a systemic issue? Joe, do you fancy having a go at that one?
I was going to say, I think this one was flagged as I said, there were a number of M&A deals that didn't ultimately happen. So this was UK Commercial Property REIT, where they announced they're in discussions with Picton in order to merge the two. Picton's not actually a trust, it's a REIT, but to merge the two companies. The reason why that was terminated, they actually announced it. It's because UKCM's largest shareholder is Phoenix Life. They hold, off the top of my head, I think it's roughly about 40%. And obviously at a very initial stage, they had a conversation with Phoenix Life, and Phoenix Life indicated they would not support the transaction. So that was a particular set of circumstances in terms of why that didn't happen. I mean, as I said, there are other deals that didn't go through, and again, it will be based on the facts in those particular circumstances. But it is fair to say the vast majority of deals that have been announced have actually completed. So those are more outliers. But that's the reason why the Picton deal didn't go through.
Thanks, Joe. This is possibly one that everyone might want to have a sort of input on. The question is, I'm interested that activist investors are regularly viewed as a threat. Could the panelists explain how they view activists? Who should we go with first? What about you, Kate? Kate, you might still be.
Yeah. Okay. I guess if it remains anonymous, it doesn't matter. We had one aggressive takeover bid from the left wing at the 11th hour during our process, and the individuals involved had no interest in maintaining biotech investments for existing shareholders at all. So that is one dramatic example of some activist investors have no interest in the views of other minority investors, I guess, and whether you want to maintain the existing mandate. So I think you need to be wary of who those activist investors are. But I do agree that boards are probably too afraid and unnecessarily afraid of investors who want to see change. And after all, we're representing them. I think that if they want to see change, we should hear what they have to say and take it seriously.
Does anyone else want to come in on that point? Joe, Gemma?
I'm happy to pick that. I mean, I would agree largely with what Kate said. I think we've got to be a little bit careful about what kind of who we're talking about and what we mean by activist investors, because there are a number of large investors in the investment trust space, and I would flag the kind of City of London's, the 1607s, the Allsprings. We see those as value investors. They obviously have an element of activism insofar as they regularly engage with boards, and again, there'll be people in this webinar who have regular conversations with those investors. But they are long-term supporters of the investment trust sector. Yes, they have a modus operandi. They buy in at discounts and they sell out at narrower discounts. But I don't see them as being activist in the sense of, say, a Saba who has a different approach. So I think we've got to be a little bit careful about kind of how we bucket investors, because different investors have got different agendas. But overall, I would agree with Kate. I think you have to look at what is right for all of your shareholders, and sometimes you will have an investor whose views are echoed by other smaller shareholders, and sometimes you will have activist investors with small holdings where their views are not in line with wider shareholders. And that's where I think the role of the board comes in to really take a step back and say, what is the right thing to do for all shareholders, not just for the shareholder with the loudest voice. And I think that's where the challenges can start.
Thanks, Joe. Gemma.
Yeah, I was just going to add to that, because I think that's a really good point. When we've been involved in two situations where activists, and they really were activists, and in one case we actually sided with the activists, and the other we didn't. But the whole point is where does it align with what our views are? And I think that is the difficulty, because it can be the loudest voice. And I think, then the role of the broker is really critical in terms of making sure that the board is hearing all kinds of views. And just to add on to that, it's always like we get, we've sent a letter and asked for a meeting, and we're like, we never received a letter. So it is making sure you've actually got that engagement and that dialogue already in place, so that you know who you need to talk to.
Thanks, Gemma. Actually, just another quick question for you from Joe Dixon, who asked that, or mentioned that you mentioned that two other houses had issued reports. Could you confirm who they were, please?
Oh yeah, I love giving free publicity to others. It's in my DNA. I think Brewin Dolphin has done one, and there's another one beginning with J. I can't remember. They've kind of done something. It's more of a quantitative thing, I think.
Thanks, Gemma. Okay, so Richard Watt asked a question. Buybacks are one tool, but is there evidence of which measures perhaps work better than others that a board can take to address discounts? Kate, do you want to have a go at that one first, please?
Yeah, I've been on boards who are adamant that buybacks are the other answer, and others that never, ever, ever would do them. So I've seen both sides of the coin. Obviously, there are other things you could do with the spare cash: special dividends, investing in interesting opportunities that the manager is keen on. So you have to be aware of the fact that you're spending money. But I am firmly of the belief that as long as it's at a discount and accretive, I think a board is indicating confidence in its mandate if it does a buyback. I think that boards are very reluctant to shrink the size of the company. I can understand why. The costs are an issue, but I also think that most minority shareholders don't really care about the size of the company. Now, we do have a problem, obviously, with certain wealth managers saying they're not interested in companies that are below a certain size. But I'm not convinced that being afraid of shrinking the size of the company is a good reason to avoid buybacks.
Thanks, Kate. We have a question on REITs. It's quite a straightforward one, actually. How are REITs responding to their challenges? Joe, do you want to perhaps pick that one up, please?
Yeah, I'll pick that. It's difficult, and I'd probably potentially widen this across the whole of the kind of the alternative sector. If you remember, one of the charts I flagged earlier showed that the biggest impact in terms of derating and widening of discounts has been across the alternative sector. The REITs have been a very big part of that. And the challenge there, just picking up on what Kate was saying about, the ability to do things about it in terms of buybacks, etc., is that when you've got a liquid assets, you're clearly quite constrained in terms of what you can do. You either have to sell assets potentially at a difficult time in the market cycle, or you need to gear up, and a lot of these REITs in particular are running geared positions. So what we have seen, there has been, when you look at it, there has been corporate activity. Aberdeen Property Income announced last week that they're merging with Custodian REIT. We mentioned UK Commercial Property; it didn't go through, but at the same time, CT Property Trust did merge with London Metric. If you look at Civitas, they were taken out by private investors. So there has been corporate activity. In terms of kind of how they've approached it, I think, as I said, that they don't have the same sort of firepower in their armory as an equity trust would have. So it is fair to say that we are still seeing very wide discounts out there. Ultimately, I think again, picking up on the discount point, the only thing that is really going to cause re-rating is performance, and I guess linked to that kind of investor confidence as well, linked to performance. So I think the REIT sector has done some things. There may well be more to come in that space. But as I said, I think there are more challenges in the illiquid sectors than there are in the liquid ones. I don't know if that totally answered the question, to be honest, but that's the best I can do.
Perfect. Okay, thanks. Now we've had a couple of questions on boards and boards composition, so we'll take maybe a couple of them and get people's views. One of the questions was, are boards in the sector sufficiently independent from the trust managers? And do the discounts across the sector in part reflect lack of confidence that boards are sufficiently independent and will act in the best interests of shareholders? Gemma, let's go with you first on that one, please.
I would say, on the whole, I think most boards are pretty independent of the manager. I would say that you have some that are so not independent that sometimes you're kind of sitting there slightly jaw-dropping, but they are the absolute exception, not the norm. Do I think that the way, this sounds awful, this terrible comment now, do I think that the average investor in an investment trust is sophisticated enough to be putting into their modelling of what they think is good value, how independent the board is? No, because if you think about it, with an open-end fund structure, you've got an advisory board, you haven't got anything like the structure you've got investment trusts. So no, I don't think that is impacting discounts in the slightest, personally.
Thanks, Gemma. Kate, you, I suspect, may well have a view on that. And actually, if I can add an extra sort of question into that one as well, what do you think? You talked about capacity and how important that was for board directors, particularly when times get tough and you really need people to focus. Can you also perhaps refer to what you think are the most important skills going forward that boards are going to need around the board table?
If I answer that last question first, I'm not a banker by background. I was a fund manager, and it was extremely helpful that I had someone who'd done corporate action on my board. So I think you need that. And you obviously need someone who's got investment trust experience. You need a chartered accountant, ideally, as chair of your audit committee, and you need someone with marketing expertise who understands how to access shareholders of the future. I think those are probably the key skills. I guess you could look at the IBT example and accuse us of being close to our fund managers because we took them with us. But we did consider all the other options. We talked to the other major healthcare trusts in the sector and talked about merging. We talked about takeover. We looked at appointing a new manager with not taking our existing managers with us. And we concluded that the people that we had on board were the best people and would be the best outcome for shareholders. So I think, I agree with Gemma. I think most shareholders really don't care about the independent board. We are the least important part of this business. But when problems are there, my God, it is really important. And obviously, in most of these cases, you are leaving your existing manager for whatever reason, and they're not going to be supporting you because they're losing your business. So the board is very important in those situations, and you do need the time and the skill set, undoubtedly.
Thanks, Kate. Can we take a slightly more general one? Wendy Dorman asked, do we think that the high-profile investment trusts that have had big issues have knocked retail investors' confidence in the sector? Joe, do you want to maybe start off on that one?
Yeah, and that is it's a really good question, if I have to be honest. It's very hard because obviously we can't interact collectively. We can't interact with retail investors. All we can look at is what we see from a trading perspective. And as I mentioned earlier, we have definitely seen a fall off in retail activity in investment trusts. And that's not to say that retail investors are selling in droves. That's not the case. Retail investors are very sticky long-term investors. What we're not seeing is what we had seen in, say, 2020 and 2021, which is retail investors adding to their positions. And as we're aware, the big retail names, some of them have had issues. Some Scottish Mortgage was probably the biggest retail sold trust for a number of years. And obviously that has had performance issues. Is there going to be a long-term impact? I think the answer is it's too early to say. I think there are a number of trusts where it does appear that the retail support is holding up. Something like City of London Investment Trust, another good example, where retail investors are still quite active in terms of buying that. So I would say I don't think it has affected it. I think there are wider impacts that are affecting retail participation, but it is fair to say that the jury's out. We have yet to see retail really come back into investment trusts, and there may be a number of factors, and it is fair to say that may be one of the factors.
Thanks, Joe. Gemma, do you want to come in on that one as well?
I mean, it's interesting. So I suppose also the other areas where we've had a bit more difficulty tend to be in the alternative space, where you tend to see fewer kind of retail investors and it's more the wealth managers. So I'm not sure whether that's kind of impacted that particularly. I think, I'm just trying to think, the private equity and also obviously a song one that didn't have a great time. So I don't know, because I think the difficulty that everyone's got, one of the questions we ask boards are, how are you trying to get that next generation? How are you interacting with the retail investors through the platforms and everything? And everyone is kind of like, it's really hard. So I think that's the difficulty, is that, none of us really know what the sentiment is of those retail investors because we can't get to them in any way.
Thanks, Gemma. That's great. And I'm just conscious of time, and I'd like to ask each of our speakers to, I guess, give us their key message from their presentation today. So shall we just do it in order? So Joe, do you want to start off?
Yeah, I'll keep it very short. I think the key message is it has been a really tough last couple of years, but there are signs that a corner has been turned. Thank
you, Joe. Kate?
I know I promised one line, but I'm going to cheat a little bit here. It's a lot of work to make changes as a board on investment trust. It much more than people could possibly imagine. I mean, I did about 200 meetings last year to complete this transaction. And so I think first and foremost, the most important thing is having a great board who could support you, which I did have. It would have been a nightmare without them. I think hiring good professional advisors who are very expensive but worth their weight in gold is also very important. And last but not least, I kept saying, by walking my dog every day, and I would strongly recommend that someone maintain something to keep perspective.
Thank you, Kate. And finally, Gemma, please.
I'm not sure I can follow that. I would say, I think going back to the whole point about all of this, it's about communication with shareholders. And we appreciate sometimes it is quite difficult to get to the right shareholders. But I think that's really how the sector continues to flourish in the future.
Thank you, Gemma. Well, all that remains is for me to thank our speakers again for their interesting and very valuable insights. We're very grateful. Thank you. And of course, to thank you, our audience, for joining us today. So have a great week and thank you again. Thanks, everyone.